Hello, and welcome to this episode of Castine Conversations. My name is Robin Hodgkins, and I'm the president of Castine. In these episodes, we meet the business leaders and the businesses involved in commission management, compensation, and compliance as they're used in both the investment manager and broker space worldwide. Our conversation today is with Indy Sarker, the founder and principal of ANALEC. Indy is one of the true global experts in CRM and relationship services that helps brokers, asset managers, and research firms with their growing authoring and distribution systems. Indy and I met as speakers at one of Substantive Research's conferences, where he is a major contributor to matters regarding commission management and the regulatory environment in which they live. Our conversation covers how Indy got into this field, how commission management has wound up where it is today on a global basis, and where things might shake out in the next 12 to 18 months. I hope you enjoy the conversation. So, Indy, thank you very much for joining us today. I really appreciate your time and your participation.
Not at all, Robin. Glad to be here.
And I guess I should probably start with happy anniversary on the 20th anniversary of ANALEC. You've made quite a mark for yourself over the years.
Yeah, thanks so much. I mean, it's been 20 years and one doesn't even realize where time flies. And it's been quite a journey. It's been bootstrapped all the way through. And we are happy that we've made that journey. But I got to say that the innovation and the struggles to keep being relevant never ends. So we're almost reinventing the company on our 20th anniversary and super excited about that.
Well, that's great. I think a lot of the conversations I have with people is about pivoting and going from one area to another and not being afraid to pivot. So, um,
Right.
starting back at the very beginning of your career when you were at Cambridge University, was there something in your studies that got you into this, or was it more of a multi-step process where you studied something and then you were interested in something in the industry and that began to develop into the interest in CRM and finance?
Great question. I read economics at Cambridge, which was certainly more on the academic side. But I've always had an interest in business. Anything to do with commercial, enterprise was always an area of interest for me. So I think at the back of my mind, I don't get a sense that coming out of Cambridge, I said I want to be an entrepreneur. But I felt that I wanted to do something meaningful, but I wanted to develop a set of skills first. Because you come out of college, what do you know? You know very little. You realize later on in life. So it was really about pursuing um, a set of disciplines and a set of skills, which sent me down the path of joining, investment banking and joining, a firm as a research analyst.
Right. So I'm always interested in how people make the transition. As you go from working for somebody, and in the case of Deutsche Bank, you've got all of these systems, all the infrastructure, all of the different teams to be able to help you out, and then you decide, I want to go out there and be. Was it a solo entrepreneur? I mean, what was the transition like? What was the mindset like to say you want to jump out of the frying pan into the fire as an entrepreneur?
Yeah, I think it's a great question. While you have the cover of that business card and you've got this massive global infrastructure, while you're there, you don't necessarily fully appreciate what you have. And I think that any decision to go and do something different has to be more than just a commercial decision. And I think it bore out of the fact that we were coming out of that dot-com bust. We were coming into a world of significant regulatory scrutiny. Elliot Spitzer in the US was going crazy and putting in some really stringent rules. And this is back in 2003 when I decided to move on. Uh, I was also, perhaps somewhat forward thinking, and I saw that the research business model was beginning to show cracks. Um, and I thought that, if I'm going to have to plan my career differently, or if I've got to take a slightly longer term perspective of where I want to be, it's always easier to pivot in your career choices early on in life than later on in life. I was all of 32 at that point with significant experience behind me. And I said that, and philosophically, Robin, I think at the end of the day, when you turn entrepreneur, and I will always say this to all budding entrepreneurs, it has to mean something to you at a philosophical and a spiritual level. Because if it's purely a commercial decision, when the going gets tough, you tend to throw in the towel earlier than normal. So it has to mean a lot more to you to want to hold on to it and fight for it, and therefore stay the course when the chips are down. So I think in that sense, um, it was a reasonably well thought through decision. It was entirely voluntary. I was number one ranked in my sector the year I decided to call it quits. So there was no pressure for me to, there was no one was pushing me out of the industry. In fact, people were quite surprised that I was willing to leave. Perhaps the timing wasn't great because research analysts continued to do well, at least for the next few years. And then you had the global financial crisis. Um, so, at the end of the day, you make choices and you stick with them and you move on with life.
And you certainly moved on, and we'll talk about some of the ongoing pivots
Sure.
that you've had. But from the standpoint of ANALEC, when you started that 20 years ago, and it's certainly developed into a powerhouse since then. Can you speak a little bit about what the initial germ of a thought was around that, and then how it's developed over the last 20 years?
Yeah, I've got to say when we and I say we because I was very cognizant from day one that you cannot build a sustainable enterprise purely yourself. You can't do everything yourself. So you had to create a team. So we in the first instance, the team was myself and an ex-colleague from Deutsche Bank, who brought some of the technology understanding, certainly in terms of what we wanted to do at that point in time. What we also realized is that if you're trying to build something in technology, and the only thing that we brought that would give us an edge over some of the larger technology players who are predominantly IT service guys, India obviously was beginning to show up on the map at that point, the Infosys and the Wipros and the HCLs of the world. Not to mention, all over the world, the IT service industry was $1 trillion plus industry even at that point. Um, was the fact that you had to bring domain knowledge. So we said, whatever we do, and we're going to stick to capital markets, we're going to bring solid domain knowledge. And the way we will look to differentiate in the market is when we are going across and pitching our capabilities, and we are sitting across decision makers on our prospect organizations, they should be able to relate to us at a business level, and our ability to solution without necessarily being too tech in our explanation was going to be our big forte. And I think that was the right call. We were able to differentiate ourselves very quickly. And that's where we got our initial breaks. We were winning mandates against bigger guys because they didn't have the domain knowledge. We had the domain knowledge. And it was really about working through the challenges when you're having to develop product and do it at a massive pace, and staying up to speed with your clients. So I think that challenge, perhaps not so much in 2003, 4, 5, but that challenge was more acute in the year 2007, 8, 9. As you're getting to a certain level of maturity, the expectations are rising, you're beginning to see larger deals, and therefore you're going to have to step up to the plate to meet those expectations. So I think in that sense, we went through that kind of transition. Of course, we had our shares of uh, bad news, screw ups, as one would expect. But it was really about how quickly can you react and rectify what you perhaps could have done better in the first instance. So I think that was really what kept us going.
Definitely, and I think the ability to pivot, to respond to the marketplace, and for the marketplace to understand that what you're talking about. You can
Correct.
bring best practices, and you bring a lot of, as you said, domain knowledge to the equation, as versus just being somebody that knows how to cut code is a big differentiator. And we've seen people that come in and say, well, we understand some aspect of your business, but really they're just a development shop. They haven't had
Correct.
all the years of experience you've had to understand what you should and should not do in a system.
Absolutely. Absolutely.
Excellent. And speaking of the transition, we'll transition over to commission management in a second. But
Sure.
on this 20th anniversary of ANALEC, you are making a lot of changes to your platform. And maybe you just talk briefly about what led to that, and again, what new services will you be offering to the marketplace before we get into the
Great.
changes that are happening
So
on the commission management side.
100%. So I think in that sense, the transformation is happening at two levels. One is SaaS enabling our kind of CRM, which, I mean, the CRM connotation is somewhat limiting because people think of CRM and they think in the context of this is just a sales platform. I think of ourselves as a customer engagement platform, which is doing way more than CRMs. It's got embedded custom workflows. It's taking into account your entire business logic and framework from originating your business right to executing. So it's not just a sales platform. It's a customer engagement and customer management solution, which is deeply embedded across our customer workflows. So having made that decision, we are continuously building out. So we've gone from just the research, sales, and trading vertical to adding the investment banking, M&A, deal flow management space, to asset management. We're in 3 verticals presently. And the idea being we're going to be in another 4 verticals over the next 18 months to 2 years: private equity, venture capital, uh, investor relations management, retail wealth advisory, and insurance broking. We think that all of these spaces in varying degrees offer opportunities, which allows us to play in a much wider market opportunity. And the way our entire SaaS platform has been constructed, it's all incremental build to reflect the specific workflows and requirements of each of these verticals. So it's not a massive rebuild exercise for each vertical, but it's really about building on it gradually. So exciting times. Our research business, which is our content management, authoring, digital rights management, distribution, compliance workflow platform, very elaborate, which is our first essential product in the market, has also been reinvented with new technology, new UI, massive focus on UI UX, because everything is about the user experience now. We're making it fun. We've got all sorts of intelligent AI tools, which starts to recommend stuff, even help you, with productivity at a level that you've never had before. So all of this stuff is exciting. And yes, I mean, we feel that you got to be able to reinvent yourself every so often, particularly if you're in the tech business. There's no room for remaining static for too long.
Definitely, and you certainly are keeping very busy, and at the same time, you're also doing a lot of work in the commission management space. So this is where we met originally at the conferences, and we've done a number of panels together. So was it recently, in the last 5-10 years, that you kind of bumped into soft dollars and CSAs, or has this always been part of the whole research process that you've been so involved in?
My interest in this whole soft dollar versus hard checks for research, or rather for in the business, came around because there was enough talk about the business model of research being challenged and how the research business model was broken, which I was quite happy to accept the fact that it was broken. And therefore, my pursuit or interest in that topic came from, so if the model is broken, what's the right model? Because at the end of the day, in a kind of somewhat selfish context, because I was going after the research segment and talking to research management across global research firms, if their business was going to be challenged, then in turn, my business was going to be challenged, because if wallet size shrinks, everyone wants to cut costs. Everybody is, the number of players shrink. And we've seen that. I mean, you've seen what's happened in the last 10 years. Number of research providers have shrunk. Number of analysts per firm has shrunk. Wallet size of these firms as a result have shrunk, or rather the causal effect is probably the fact that the wallet size shrunk, which led to the retrenchment. And yeah, I mean, it was really a simple case of saying, how do we remain relevant? And then I came across, we all know our friend Mike Caradas, and Mike and I spent a lot of time, almost 3 years before MiFID II regulation came about, and we had a genuine passion for that topic. In fact, we were one of the founding members of the Unbundled Conference framework. We did a lot of closed door breakfast sessions with a bunch of clients in
Big
London. We
sponsor. You've
used to
always been a big
hold a
sponsor of
whole,
that. Yep.
yeah, a whole gamut of stuff. And I also wrote a lot of thought leadership pieces on what MiFID II meant for research. And I would say that and you probably would acknowledge that I was very controversial in my views, where I didn't think MiFID II for research had a future. And my concerns around the fact that MiFID II was meant to, I keep stressing the word meant, to address two factors. One was investor protection, and two was to create a more competitive market for research. I believe, taking the second one first, the competitive market for research meant that the regulators said, we want to create a market which is more competitive, in other words, allows for independent research providers to come in. We want to break the stranglehold of the big global organizations that dictate terms. We want to drive more transparency. And the transparency argument was around the fact that the classic principal agency problem between asset owners and asset managers was addressed. And we're going to make sure that these guys are not being irresponsible and not overspending on research, et cetera, et cetera. I think it was massively overblown. And you and I have been on panels where, when you start to look at what does it really mean in terms of the cost of research in performance drag, and if you are targeting alpha, and let's assume, risk-free rates of return were at 5% or 6%, I'm just making up this number. We did some basic back of the envelope calculations right earlier on in the game, and no one's really disagreed with that the performance drag as a result of the research costs being part of the soft dollar, or rather part of the bundled rates, was about 25 to 30 bips. Now, 25 to 30 bips as a performance drag because you're paying for research out of asset owners' money. And if that's going to break the bank, I think you're basically shooting the messenger.
Absolutely.
Your problem is elsewhere. Your problem was the fact that you were not generating alpha. Point me one hedge fund that has consistently delivered alpha, where their asset owners have come to them saying, tell me how much you're spending on research. It's not even a conversation.
Exactly. And I've had that same, obviously we certainly agree on the same point as far as that component of MiFID II being a kind of a disaster from day one. And people keep on talking about the research cost, and it really all comes down to performance in my mind.
But, as long as it was bundled or some level of, soft dollar arrangement, service providers were quite happy with that. But it is a bizarre arrangement that you decide to pay what you want to pay after you've consumed the product. And it's really the recurring nature of the relationship that governs those payouts, which I think to some extent people miss the point.
I think they did. I think they did. I think a lot of the regulators missed the point, and they missed the focus that they needed to, or they had the wrong focus on the marketplace. So now England is beginning to, has very significantly made noises about making changes. Europe has already made a lot of changes. The U.S. is basically saying we're not broken, so we're not making changes of very significant. So maybe you could just kind of summarize briefly about your thoughts about where England is now, and where Jeremy Hunt and Rachel Kent and the FCA are beginning to move with the new rebundling, the potential of rebundling.
So I'm going to take a step back and just spend a couple of minutes on the backdrop of what's happening in Europe. So Europe, certainly France and Germany, realized very early in the game that this stuff is not working. So what do? You're the ones that led, along with the FCA, this whole regime on MiFID II for research. So you have to come up with some kind of political, what I would call face save. So the first thing you did is you took fixed income commodities and all of that out of the equation. So you're free to go and bundle yourselves and get paid the way you want. In other words, go back to the old regime. You then introduce the fact that bundled commission payouts is okay for companies that are less than €1 billion in market cap, which was, it was clearly an acknowledgement, more than the fact that what it did for the market, it was an acknowledgement that things are not working out because coverage was shrinking, lots of research providers were vanishing. Issuers, people who wanted to come to exchanges and want to get themselves listed, were saying, why would I want to list with you guys if you can't get me proper coverage? And this is a huge problem in the UK, which we'll get into in a second. And then what do? You basically turn around and say, oh, we're going to raise that threshold market cap to €10 billion. Now, I'm going to give you some stark facts on Germany and France. 6% of listed companies in France have a market capitalization of more than €10 billion. And the number for Germany is 11%. Now, I can understand that trading volumes probably dominate 40, 50%, probably is dominated by those 6% and 10% firms. But the fact is, you basically made MiFID II, the fact that you had, the fact that research had to be paid through an explicit check, almost irrelevant for most companies, because it was now being made out that it's the issuer that gets to determine, or rather the value, the market cap of the issuer determines whether you're allowed to pay for it through a bundled or some kind of other arrangement.
Definitely.
The problem is the enforceability of that. What rules you need to do. These firms are all struggling with these idiosyncratic announcements that keep coming out. Now, coming to the UK, this was so obvious. All the points that they are quoting now, the fact that the stock exchange is worried about issuers not coming to them to list, the fact that you got a liquidity crunch for lots of companies that are not getting adequate coverage, the fact that you have the classic problem in the UK where research is more and more concentrated in the hands of the top 10 providers, the so-called global bulge, although I don't think we refer to them as the bulge anymore. So all the factors that supposedly MiFID II was going to address in a positive way, it went exactly the other way. You've had more concentration. You've had shrinkage or reduction in coverage. You've had everything that you were worried about has come through, and you've got a market where issuers are preferring to go to the US to list, despite the US being a more onerous compliance regime and therefore higher transaction costs than the UK, or for that matter, France and Germany. Certainly issuers of size, and of course there's the smaller cap domain, but small cap and mid cap are going through a horrendous time. There's virtually no coverage. People don't pay for them, but the cost of coverage still remains reasonably high. If you look at a research organization, what do they spend in terms of the analysts and the overall costs, and then look at what their coverage is? I remember we did this math back in 2017 for some of the mid-tier regional, not global, but mid-tier. We're not having to go even too high. The cost of coverage is $55,000 a company per year. Now that was an untenable model, and I'm quoting low numbers. If you go slightly larger funds, it's even higher than that. So challenges galore on that front. So from a UK standpoint, I think they're going to go back to the old regime. And I feel you're going to get some kind of hybrid between CSAs and the RPA concept of setting a research budget, and you're going to go back to perhaps commissions coming into the forefront to pay for services, because the European and certainly the UK asset management industry is uncompetitive, is below scale and uncompetitive compared to the US at this point. So you're fighting multiple headwinds.
So do you think with the way that England is headed, and I know there's going to be the consultation paper coming out, the FCA is, I think, certainly being pushed by the political side to make changes, and I believe at the end of the day they will make those changes, despite some of their probably internal debates about whether they should be making the changes for the reasons I think you so well enumerated. Do you think at the end of the day it'll wind up with a single global platform where all regions operate the same way, or do you still think that England will have its own idiosyncrasies in the CSA space?
I think in terms of specific regulatory provisions, you might have one regulator having slightly different point of view as it happens. These are all very bureaucratic organizations. There are egos involved and all the rest. But I think if it really comes down to commercial value and commercial models, it's critically important to be competitive. And therefore, what's going to make a particular country or a particular regulatory jurisdiction competitive in the context of issuers, in the context of people who cover the market, in the context of making the asset management industry competitive, you're going to have to really think hard and perhaps rely more on market forces to drive allocation of resources as opposed to the old school regulatory diktat that I expect you to do X, Y, Z, and let's face it, while there may not be an official admittance of the fact that MiFID II for research was a disaster, the very fact that they're having to junk it all tells you that it's been an unmitigated disaster in that sense. It's only destroyed what could have been handled way better. I mean, just because you have a problem doesn't mean you need to over-regulate for an industry that can potentially be handled. I've always said this. You've seen me on all panels. I've said the US is not going to touch MiFID II regulation with a barge pole. And the fact that the US has stood its ground and basically said no action relief will not be extended any further, I think it's also to preempt the hand of the European regulators to say that it's about time that you guys fall in line and we create a kind of global platform. Now, my views are controversial once again, because I think there is a school of thought that says, oh, no, things have moved to the P&L. It's never coming back. And therefore, it remains as is. I'm not so sure, frankly.
I totally agree. And we've had a lot of conversations with people, and you and I have spoken a bit about this on the side, but a lot of people, a lot of the investment managers are looking at this and saying, who's going to go first? And I know in 2017 we were in the middle of the whole MiFID II world and getting ready for RPAs, and we saw the dominoes drop very quickly from the large, asset managers making the move to P&L first, and then they just very quickly swept through the marketplace. Do you think that this time, where the whole concept of rebundling is in theory going to happen, will the concept of going back to using client commissions be started from the smaller firms creating a groundswell, or from the large firms saying, we can just notify our clients we're going to do this, disclose it, and then the whole market will shift again from the large size down to the small firms, or perhaps the other way around?
That's a great question. The problem is that when you think of it in an industry context, the smaller firms have to be lots of smaller firms to impact the overall wallet impact, you see, which then creates the groundswell. And the problem with most smaller firms is they've largely just waited to see. They've been price takers, right? They rely on what the big firms are going to do in this space. The problem, and this is where it's going to get interesting, is that to some extent, the larger firms took the squeeze in the wallet size and the contraction and said, hey, you know what? We've had a squeeze in the overall wallet size, but we've also grown market share. So while the wallet may have decreased 30%, they may have only had to take a 12% hit because they've grown their market share. So to the extent that they are feeling the pressure, I'm not so sure. But having said that, I would also maintain that if you think about the US, and this is where it's interesting, the US had gone down this unbundling path through CSAs and creating research budgets where they were negotiating an absolute cap, in absolute terms with each of their clients for what they ought to get paid during the year for research services, although coming out from the commission, in a kind of bundled sense. It was a portion of the commission was going into a CSA account or some arrangement, and that was going to fund those budgetary limits. And anything above the budget needed approval if you did an exceptional job and they're willing to pay you because they've got more coverage out of you in other markets or whatever it is. So I think you've got to rely on sensible people transacting business on both sides, the provider and the consumer, like in any other market, to agree on a set of commercials. I don't think this is a domain for regulators to step in, considering, like we said, the performance drag. Now, you might argue that, hey, you know what, 20, 25 bips performance drag is huge, in a world where in the US, you're fighting passive versus active, but that's a different fight altogether.
Sure.
I don't think by eliminating a 25 bip performance drag, you're addressing your loss to the passives.
That still exists.
You've got a different problem to address. So it'd be interesting to see. I don't have a point of view, but I still believe it's going to be some of the larger guys. There's going to be one or two large guys. And perhaps I think this is Europe that has to take the lead, because it's the Europeans that voluntarily went down the path and said, we're going to be P&L. The regulator didn't force them to go P&L. The regulator said, you're going to have to be more transparent, and you're going to have to create these research payments accounts. You're going to create more transparency on that. They say, oh, we don't want to deal with all of that. We're just going to go P&L. Now, you're dealing with the consequences, which means that your pre-tax earnings for most European asset managers took a 20% hit as a result of that decision. And you haven't really impacted performance either. So your ability to scale your AUM so that your fixed overheads of your business is able to accommodate, as a result of scale, you'll pick up some of the margin loss. You haven't delivered that either. So it's been a loss-loss situation in so many ways for them.
So we're talking about a more consistent, but not 100% consistent regimen around the world. Maybe Europe leading the way to be the fulcrum to get England to change as well. So there may be some differences in the marketplace, but looking at it from the standpoint of the research firms, what kind of a horizon do you think they need to be looking at, those firms that have been affected by this disastrous MiFID II aspect on research side? What kind of horizon do you think they're going to have to look at to get their business back, or is it never going to come back for them?
Good question. I would say that from a service provider standpoint, and I'm going to include research as a service provider landscape, if tomorrow they had to move to a bundled rate where they're now being paid through commission dollars, the market's going to celebrate. And they can go back to that world almost instantaneously. I say instantaneously, but perhaps some level of administrative workflows will change within the firm. But it's not an insurmountable task. The task is perhaps slightly more onerous on the buy side, the asset managers. But it's really about unclogging, what you created, and therefore perhaps there is a kind of happy path in that kind of direction. So my view is that you're probably going to need the service providers. I don't think they really need any lead time. They're just going to start billing you differently. I think the service provider landscape, the sooner the better. And I think that's what, if you read between the lines, I found it very amusing when I read one of the news reports where one of the journalists covering this UK's move said, it almost suggested as if Europe, as in Germany and France, were the ones that had pushed for this onerous set of terms, whereas it was the FCA that was the most vocal. This is pre-Brexit, if you remember.
Yeah.
And now the FCA is saying, well, it was really the Europeans who were pushing us to do this, and we want to essentially look to unwind it. But the FCA was the most vocal.
Absolutely.
In terms of driving this change. So it'd be interesting to see, but the way the headlines are coming through, I think we are back in a world of rebundled. I think you're going to see the US model of CSA perhaps emerging as, I wouldn't say the gold standard, but certainly something similar to that starts to emerge. And you are seeing transparency in the UK in an unbundled sense. And commissions are going to get used to pay for research, and you're going to get back to some kind of research cap, perhaps in one-on-one client relationships, like you
Yeah,
would negotiate any commercial transaction.
definitely. And I think we're looking at probably a horizon of 9 to 12 months, 18 months going out there as far as people that are beginning to prepare. Some people are
Uh-huh.
putting their toes in the water. They're beginning to kind of reinvigorate the whole CSA model internally, but they're not going to jump on it right away. It's something I think is going to roll out over
Yeah,
2024. So I
yeah,
think the
I could
research
agree with
firms
that.
will also
Yeah.
benefit during that same time frame. And I think disclosure is great. I think some of the additional reporting, there's the pendulum's got to come back to something that's reasonable. I think this new movement out of England will bring it back to something that's more reasonable. Bring it back to ANALEC and your
Sure,
business, because obviously you will benefit from the research side of this as
sure.
well. What kind of headwinds do you see on your business that are coming from these discussions, or is it quite separate in your business as far as where you're headed?
I think there's a combination of factors. We're always, as a business, and there are two aspects. So when you're working with the brokers, and there when you work with the research providers and the sales and trading function, um, market volumes tend to dictate a lot. In fact, I was just talking to one of our clients in Asia, and I'm not going to name them. And one of the things that the conversation said is the first quarter of this year, this calendar year, they were up 100% on a sequentially quarter on quarter. So I'm talking January to March 2023, 100% on October to December 2022.
Incredible.
So they were on a phenomenal roll. And then you had all the bad news coming out of China, and China, Hong Kong dominate the flows in a kind of normal trading volume sense. China is down almost 45-50% in traded volumes. Valuations are taking a hit. There's a lot more geopolitical macro risk. There's also the kind of real estate debt crisis in China that's emerged, which is perhaps also leading to this. So traded volumes dictate a lot of revenue momentum for a lot of the brokers. So even if you are gaining market share, you're still going to take a hit in absolute terms. So that's a concern. Um, and the problem with China and Hong Kong being so dominant is the fact that when you have a downward market, even M&A slows down, listings take a beating, so everything tends to just start to slide down. So from our standpoint, the exciting piece about our business today is that there's no room for standing still. So continuously innovate. We also realized that we were far too niche as a company, purely on the kind of sales and trading research world.
And expanding in new verticals now.
So we are expanding. We are adding more verticals. Like I said, we're already in 3 verticals: banking, M&A, advisory. We've got a phenomenal platform to support bankers, even the firms that have 10 bankers. We've got great capability at a great price point, which is great for them. Asset management, the institutional sales effort at asset managers, where they are pursuing pension funds, endowments, et cetera, to give them active money, wherever they are. So that's another growth area. Um, and then research, sales, and trading. Beyond that, like I said, private equity, venture capital, investor
Brilliant.
relations, retail wealth advisory, and this is something which is interesting from a workflow standpoint that we feel has room, and perhaps for third party, collaboration and integration. The sub $150,000 savings account in the emerging world in Asia Pacific is absolutely exploding. And you can't throw a lot of resources to those. But if you can get smart tech at very low incremental cost to be able to manage those workflows, to deliver the service that you need to deliver them, you're onto something. So I think it's a lot of those aspects keeps us quite excited about the future.
Well, it's a very exciting time for ANALEC, and again, congratulations on 20 years, and I'm really looking
Thank you very
forward to
much.
seeing what's going to happen over the next few years, and with the rollout of the new products and the new verticals. Indy, thank you very much for your time today. It's been really fascinating, and I look forward to sitting on another panel with you soon.
Fantastic. And Robin, thank you so much for thinking of me. And I really enjoyed this chat. And like I said, we're happy to do more sessions.
I'd like to thank Indy for spending time with us today. I am most grateful. For more information on ANALEC, please visit their website at analec.com. That's ANALEC.com. For more information on Castine, please visit castinellc.com.